The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The S&P makes another tepid run for what would be its first record high so far this year. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele, but second intraday record high. I mean, whatever.
Thank you. But who's counting?
I mean, you gotta do something, right? Taking a look at S&P up 0.2%. Here's the number to cross, 60.90 spot 27 if we get that record high. But on an index level, I gotta be honest, Romaine, not that much happening. The Nasdaq, the underperformer, kind of dragged down by chips to some extent, and the VIX continues lower. I said that yesterday, right? The lower the VIX goes, the more those volatility-controlled funds are gonna have to buy.
Yeah, still, Alex, a record high is a record high, but we should point out, as I think Alex's sentiment reflected, this is probably one of the more paltry record highs that we're going to have for the S&P, should it actually hold onto these numbers into the close. Now, remember, the index opened lower, but it's actually been limping higher, kind of like verbal Clint. Above that key 6,090 level, only one of the Mag 7 names are really in the green right now. And the biggest percent gainers right now, that's going to be found in utilities, energy, and industrial companies. Not necessarily what you want to see. And a big part of the reason why, well, is because we're not seeing any of the strength out there from some of those big tech names. That curious downdraft in chip stocks causing a lot of concern. This after Korea's SK Hynix, the main supplier of high bandwidth memory to NVIDIA, reported record quarterly results. Great. It gave a stunningly bullish commentary on the future. Great. But investors seem a bit wary, concerned about a stagnant smartphone market and the potential topping out of AI spending, both, of course, which would threaten one of the hottest tech trades in a generation. Meanwhile, miles away in Switzerland, Davos man isn't aiding the cause much either. U.S. President Donald Trump beaming in to address the business elite at the World Economic Forum. And he even took questions from a handful of corporate executives, addressing a wide range of issues from tariffs to oil to his desire for an immediate drop in interest rates worldwide.
My administration is acting with unprecedented speed to fix the disasters we've inherited from a totally inept group of people and to solve every single crisis facing our country. My message to every business in the world is very simple. Come make your product in America, and we will give you among the lowest taxes of any nation on earth.
And, of course, the president of the United States speaking from the White House to the elite at Davos. We're likely to hear from the president later in the day, but we kick you off to the close with the refocus on markets. Stephanie Larosilier, head of fixed income business strategy and development at Invesco, joins us right now. And Trump may be dominating the stage, but we kind of forget, Stephanie, Jay Powell is going to dominate the stage in about a week's time when the Fed has to make another rate decision and communicate to this market where rates might indeed go. They've kind of been pinned right now in a relatively tight range the last couple of weeks. Are you anticipating any sort of a breakout in either direction?
We actually aren't. We think that right now it's going to be very, very tough for Jay Powell to make any significant changes. When we look at, core PCE inflation, that is kind of, trended up. So it's going to be difficult for them to actually look at making a cut. We actually don't see anything on the table for January. We think, March could be, on the table depending on the data. But right now, all eyes seem to be looking at June for the next rate cut.
For those folks who are looking to either buy into the Treasury market or maybe increase positions or even decrease positions, is there an opportunity to do that right now? Do you have the comfort level to actually increase your allocations?
We feel good about where the market is right now. We think, looking at the longer end of the curve makes a lot of sense. So if you're looking at treasuries, you want to lock in, these higher yields where they are at this point in time. We also really like, corporate bonds. Fundamentals have been great. When we look at, forward-looking, probability of recession, we've gone from a 30% probability in the summer of 2024 to now down to 20%. We think we're going to continue to see the economy grow at a very strong tick. I think consensus now is about 2%. At Invesco, we're calling for about 2.7%. So from a macro perspective, everything looks to be pointing in the right direction for continued positive momentum.
We keep seeing calls for, say, 5% on the 10-year. Some are even saying 6%. The latest was today for UBS at 5%. Are we expecting that kind of move in the bond market?
So we definitely don't think 6% is on the table. That's a little bit further out than where our expectations put us. But we do think, right now, we're looking at 4.6% or so. 5% is not without, there is a range. It's going to be range bound, but 5% is within that range. So that could certainly be on the table.
And all of this obviously hinges on that U.S. exceptionalism and outperformance, right? That's why we've seen the strong dollar. It's why we've seen higher yields. It's why we've seen the investment grade market continue to do well. How much of that thesis do you think we have to run?
We think we expect U.S. exceptionalism to continue, at least for the next, 1 to 2 quarters. Really, this is going to be based on a lot of what President Trump now is discussing and the speed at which his various policies actually come into play. So, our expectation is that we're not going to see a big bang and see everything happen at the exact same time. As long as we have, some time to digest the various tariffs and various changes to policy, we think the economy will continue to do just fine.
When you take a look at the dollar and some of the moves in FX, obviously a very phenomenal year if you were invested in the dollar last year. I don't know if that's actually good for corporations and the bottom line. How do you factor that into your forecast for 2025, Stephanie?
When we think about the dollar, we think about, really the other things that are taking place. We think there are other issues and other policies and animal spirits that are really being focused on a level that we haven't seen. If we look at, financials that all reported record earnings, we believe that we're going to continue to see that momentum continue to take shape. We believe that we're looking at, unemployment coming down. We're looking at a labor market that's going to continue to do well, even in the face of potential deportations. We don't believe that when it comes to, the deportation that we've heard of thus far, it is specific to, those that may have a criminal background. So we don't think that's going to affect the labor market significantly. So we believe that this will continue to see the positive, strong momentum that we've seen here over the last couple of weeks.
I do want to ask you about one corner of the fixed income space that we don't talk a whole lot about, but seems to be getting a lot of activity, and that's in the municipal market. Just yesterday, we learned that Newman launching 2 active municipal bond funds, and they're not the first. There's a long line of folks out there who have been launching new funds. There seems to be a lot of investor appetite for this, and I am curious as to why.
Well, municipals have long been, I would say the market's long tried and true financing vehicle for infrastructure. And when we think about the infrastructure of America, we think about all of these natural disasters, we think about all the things that are taking place in the world. Municipal bonds tend to be the financing vehicle for that. And then, the thing that, munis has that no other asset class has is that tax exempt income. And, with, rates getting higher and higher, we're now looking at, our high yield muni fund, a tax equivalent yield of over 9%. We actually have launched some funds as well here. We've launched a high yield ETF. So there's tremendous opportunity in the muni market. We think people, know that it's not what you make, it's what you keep. And what you keep is very important. That's going to be something that municipals will allow people to do.
Right. As long as the tax structure doesn't change for those guys. That's obviously the big question mark. Before we let you go, though, clearly you're comfortable taking duration risk. I'm wondering just how much credit risk you're willing to take.
So at this point, things are really tight. We feel that, in the investment grade market, that's really where we feel the most comfortable at this point in time. We're not stretching for yield. Within emerging markets, we think, there's a lot of tariff risk there. So we are relatively on the sidelines when it comes to that. But when in the investment grade space, we feel good about the credits there. We think that there's strong technicals. We're looking at, another bite at the apple potentially for those that didn't get in the investment grade market at 5% and over yields. And the market's now, at a record for January in terms of issuance. So we feel pretty good about what we're seeing in investment grade, and that's really where we would focus most of the attention.
Stephanie, always a pleasure. Stephanie Larosilier kicking us off today, head of fixed income business strategy and development at Invesco, as we focus on the markets and we focus on Washington with President Donald Trump's Davos commentary moving oil markets. We're going to break it down what his comments mean for commodities with Natasha Kaneva, head of global commodity strategy at JPMorgan.
And keeping with the Trump administration, a look at how his presidency will affect crypto markets and American business with John Koudounis, CEO of Calamos.
And Electronic Arts having its worst day since 2008, a pioneer in the video game space. Investors raising a lot of questions about what the future holds. We're going to talk a little bit more about that stock coming up later, right here on The Close on Bloomberg. Another focal point at Davos, in addition to President Trump, is artificial intelligence. And we should point out to our viewers right now, we are learning that Trump is in the Oval Office and is expected to sign an executive order involving AI, an action related to AI. Those are all the details we have right now. But we should point out there's been strong acceptance of AI as the driver of the next wave of economic growth. We heard that out at Davos. We heard that even before Davos. Joining us right now to discuss is a man out in Davos, Dan Newman. He's a CEO over at the Futurum Group, and I'm sure you've had a very long and busy week. I know it's late out there in Switzerland. Let's start off with AI. We don't know exactly what this executive order is going to be, but maybe we get a little bit of a taste of that from what we learned on Tuesday with Larry Ellison and Sam Altman and Masayoshi Son and all this investment in AI. I know you've been tracking this too as well, Daniel, with regards to not only what the White House is going to do, but what CEOs themselves want to do.
Yeah, Romaine, it's been a very interesting week. First of all, it's been the most positive I've seen the business leaders in a number of years. I spent time with CEOs like Chuck Robbins, Bill McDermott from ServiceNow, several others this week. And, part of what I do when I'm spending time advising these folks is I'm trying to, really measure the temperature. And we knew this week was such a big transition. And Davos really focuses on the world. But with the Trump inauguration, it was really in focus this week is how the U.S. will lead policy around the world. And it was very clear in the remarks Trump made today that AI is going to be the driver of our growth. And as you said, and it's something I've said, is that AI is going to be the next front in which the economy is won. So we are taking no risks except for deregulating everything to enable these tech companies to go faster. And when I talk to these CEOs, all of them are basically saying they're excited about AI and they're even more excited about the deregulation, and they see massive opportunities over these next few years to grow and do a number of things they just weren't able to do during the past administration.
When do we start seeing, Daniel, though, the actual fruits of all this labor? Because whenever we hear from some of these big business leaders, they're talking about the amount of money they're spending to develop AI or build data centers or do whatever, but they're not necessarily saying, okay, we're generating revenue or we're generating significant cost savings yet. When do we get that?
Yeah, Romaine, this is the big inflection. This year was what I call ROAI. It's the return on artificial intelligence here. And the CEOs are asking that question. We did a survey in partnership with Kearney. We talked to 210 CEOs of companies that have over $1 billion in turnover. And that is actually the challenge they have. They see a little bit more of a long tail. As investors have seen, companies like NVIDIA has paid big in the near term because people are seeing the AI dollars. But other companies, the SaaS companies, some of the infrastructure companies, like Microsoft, they're saying we're spending 40, 60, 80 billion and only having 2, 4, 6 billion of revenue. They're saying it's going to take them like 3 years. 92% of these CEOs say 3 years to get that kind of value. And so we are looking at this and basically saying there is a short tail, which is all about CapEx. If you're an investor, it's CapEx focused. But there's a long tail that's going to pull out costs. And we see even as much as 4 trillion, Romaine, being pulled out in the next 12 to 18 months if they can implement these agentic and generative AI capabilities.
So I guess the question is, what companies are best poised to do that? Like, are they old companies that have like a super solid balance sheet that have the cash flow to sort of sustain it? Is it younger companies that may be more nimble but don't have that cash to sustain this sort of tail?
Yeah, Alex, that's actually a really, really good question. So old companies are actually up against a bit more of a cultural challenge. So a lot of these surveys, and you've probably seen it in the past with digital transformation trends, big data trends, mobile trends, it's like the technology starts to roll out and then you hear, we can't get people to adopt it. And that's what these CEOs are basically saying is the next big wave. The way we get to those bigger AI numbers is we need to get the CEOs to delegate the AI requirements and opportunities through their organizations and get people to actually use it. Because here's the thing is CEOs aren't using it the way the frontline workers are. And if they can't really sell that, hey, this agentic assistant is going to add value and your job is secure, these people are going to get nervous. I mean, we hear a lot about economic efficiency with AI. We haven't yet fully comprehended where that productivity comes from, but everyone feels it's coming.
So when we hear grand announcements like we're going to be investing hundreds of billions of dollars into AI infrastructure, and then you hear from the companies, how wide is that gap?
Well, I mean, these CEOs are saying 3 years or more. 92% of them said that. And, you still have a significant amount. 8% are saying, hey, it's going to take us even more than 3 years. But I think this is also where we have to kind of bifurcate between where investment opportunity exists and where enterprise growth from AI comes from. The infrastructure build out is going to take multiple years. A $500 billion project like Stargate, this is going to be years of building. And so those opportunities in chip makers, in infrastructure makers, in power, thermal management, security, networking, those players that we're hearing from, though, they are going to be able to monetize this immediately.
Yeah.
These longer tails, though, are going to be where enterprises start to derive value. But that doesn't mean SaaS companies, Salesforce, ServiceNow. That doesn't mean Dell. That doesn't mean that NVIDIA, AMD can't see lots of growth right now, because the buying and implementation is happening starting now.
All right. Hey, Daniel, we really appreciate it. We know it's been quite a big and long day and week for you. Thank you very much, Daniel Newman, CEO of Futurum Group. All right, some breaking news for you. United Health is promoting the head of its Medicare health plan business to now lead the company's broader insurance division. Of course, previously filling the job held by executive Brian Thompson, who was murdered outside a hotel right here in New York. Tim Knoll is a gentleman. He's currently the CEO of United Health Medicare division. He will become the CEO of United Healthcare Business. That stock up over 1%. All right, coming up, shares of GE Aerospace are on the move, exceeding expectations for profits and sales last quarter. More on industrials in our Top Call segment. This is The Close on Bloomberg.
All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start with Chewy, Argus Research, which downgraded the stock to hold just 6 months ago because of declines in its active customer list. Reversing course today, an upgrade to buy. The analyst praising management for its refocus on high margin businesses and expansion initiatives, which should drive sales and earnings growth. Those shares right now at their highest level since mid-2023. Meanwhile, Boston Beer sliding for a second day. This after Piper Sandler cut its recommendation to neutral. Sales for the beer maker's alcoholic Twisted Tea brand aren't where they need to be, says the analyst, and the launch of a hard Mountain Dew beverage was just a bit too flat. That stock down 2.5% on the day, and we should point out it's starting 2025 with an 18% slide. But that's nothing compared to what we're seeing out of Electronic Arts, EA plunging the most since 2008 after the video game maker slashed its fiscal 2025 net bookings guidance. Analysts at 3 firms downgrading to neutral equivalent ratings. That includes Raymond James, which says player engagement shortfalls in 2 of EA's headline games could lead investors to question the execution of future projects. We're going to dive deeper into EA just a little bit later in the show. But let's turn from one of the worst performers in the S&P to one of the best performers today. That is GE Aerospace, the jet engine manufacturer, topping Wall Street expectations for profit and sales in the final months of the year. You see the shares getting a nice pop here on the day. In fact, right now having their best days in the wake of that separation back in 2024. Jason Gursky joins us right now. He's an analyst and managing director over at Citi. He's got a buy rating on the shares. And Jason, I do want to kind of go back to that separation. I think it was April of last year. And there was a lot of questions as to how these stocks would perform. GE Aerospace has been doing pretty well. Is this a management story? Is this a sort of a broader economic story? What's driving it?
Oh, it's a little bit of both, right? They certainly have some nice tailwinds from a macro perspective going in their favor, right? Post-pandemic, we're all back and flying, so traffic growth has been good, which supports the aftermarket business at GE. In the years to come, we should see production rates from the OEMs like Airbus and Boeing continue to drift higher, so that grows the installed base at GE. So they've got some nice macro trends going on here as we all get back to flying. And then on the management side, you've got a team here that is very well experienced at eking out efficiencies and productivity, and they are very focused on driving efficiencies in the business and driving margins higher.
When you talk about recommendations and buying this stock, is this a growth stock? Is this an income stock? I mean, how do you view it?
Well, increasingly a little bit of both, right? With the announcement today, they decided they're going to increase their dividend by roughly 30%. So we get a better yield there. They're buying back stock. Going to buy back $7 billion worth of stock here in 2025. So this is a bit of a cash returns story. But in addition to that, we got some nice, really nice cyclical growth going on here in the aerospace business. And then, longer term, we've got global defense budgets that are also rising. So that should be a nice tailwind for them for many years to come. So lots of good visibility here on the growth side. And we're now getting the cash returns for shareholders as well.
Jason, Boeing is a huge customer to GE, 10% of revenue. What's our Boeing read through on this?
Well, let's see here. I mean, it's constructive, right? I mean, the orders for GE were up nicely during the quarter. The demand that they're seeing from their airline customers on the aftermarket side is really robust, which suggests the traffic growth is going to be solid. That should give us comfort on the order book for Boeing. If airlines are seeing traffic growth, they're going to need more planes. So it's a positive read through into Boeing as well.
Talking about their margins, they were slightly lower margins for this year in terms of their guide. Do you think that they're being conservative and there's some upside here?
Yeah, a little bit. I think that a little bit of that was driven by mix, right? The aftermarket for them is the high profit center. They make less money, even lose money sometimes when they ship in new engines to aircraft. It's kind of like the razor blade model, where you want to get the installed base growing so that you can sell lots of razor blades over time. So a lot of that was just driven by mix. Fewer aftermarket deliveries than they expected, because of some supply chain bottlenecks. Believe it or not, we're continuing to hear that consistently still throughout the aerospace and defense industrial base, supply chain bottlenecks. So I think, look, it's just a question of time before they start, getting those things in a better spot, and we begin to see some pretty good consistent margin expansion from GE.
I am curious, Jason, particularly on the defense side and how that folds in with what may or may not come out of the Washington budgeting process. When we talk about defense spending, and I know there's other countries besides the U.S. that they rely on, how much is this going to be a feed through, particularly as we start to see new contracts come in for the big players, and then, of course, how does that feed through into a company like a GE Aerospace?
Yeah, look, I think you start with the geopolitical environment. Is it getting better, getting worse, that kind of thing? It's still pretty tense. The last time President Trump was in the White House, he pivoted the United States to China and the Indo-Pacific as being the big area of concern. Clearly, you're going to need assets that fly and float if you're going to be concerned about the Indo-PACOM and that strategic area of the world. And that's the kind of thing that GE does. So, look, what I would expect here is for budgets to continue to drift higher here out of the United States. We've got some Republicans in Congress that over this most recent summer suggested we should be driving spending to 5% of GDP from about 3.5% today. So that would lead to some really nice high single digit, maybe low teens type of growth from a budget perspective through the rest of this decade. And then our allied partners are probably going to spend more too as President Trump puts pressure on our European NATO allies in particular to spend more. So it's all pretty good read through for GE and its defense business.
Hey, Jason, thanks a lot. Really appreciate that. We definitely heard that rhetoric today. Jason Gursky over at Citi, thank you very much. All right, coming up, we're going to check on commodities outlook under a second Trump administration with Natasha Kaneva, a commodities strategy global head over at JPMorgan. This is Bloomberg.
I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil. You got to bring it down, which, frankly, I'm surprised they didn't do before the election. That didn't show a lot of love by them not doing it. I was a little surprised by that. If the price came down, the Russia-Ukraine war would end immediately.
That was President Donald Trump moving the oil markets just a bit here, speaking virtually. Two leaders at the World Economic Forum in Davos, Switzerland. I'm Romaine Bostick.
And I'm Alex Steele. And it wasn't just oil. Also, he talked about coal, clean coal, saying that we need clean coal. And you have Peabody Energy rallying as well. He talked a lot about U.S. LNG exports, how they're definitely going to supply Europe. It was a pretty energy-heavy speech he had earlier.
Yeah, and then this is a lot of stuff that he was on the campaign trail talking about. And now, of course, what is this, I guess, day 4 in office here, more or less 3.5. And he seems to be at least trying to make good on some of those promises.
So here's what a lot of commodity strategists are trying to do. They're trying to understand what tariffs are, how you price them into the different commodity markets. And a lot of them wind up looking at the ARB, different prices, different parts of the world, and that's how you have to trade it. Well, for her take, Natasha Kaneva joins us. She's global head of global commodity strategy over at JPMorgan. I have to say, your team has done a phenomenal job of breaking down every commodity, and we could talk to you for like 25 minutes, but we have like 7. So we'll start with oil. Is Saudi Arabia listening to President Trump?
President Trump, first of all, thank you for having me. So President Trump wants substantially lower prices. Yes, some of the senior officials in the incoming administrations are talking about $50 oil. So President Trump wants significantly higher production in the U.S. and OPEC immediately today. At the same time, there's a dichotomy within the Trump administration because on one side they want $50 oil, on the other side they're talking about bringing back maximum pressure campaign on countries like Iran, Venezuela. They're also talking about enforcing, harsher enforcement of sanctions on Russia. So what that means at the moment when we look at the numbers, especially with the latest round of sanctions, the numbers are becoming very, very large. And just to give you a couple of examples. So today, 20% of all the Aframaxes, those are the big boats that are moving oil volumes, today they're under sanctions. 20% by our estimate, about 20% of the global oil today is traded under sanctions, and is traded most likely outside of the US dollar. So that's where we come back to the remarks from Scott Bessent during his hearing, is that he said the sanctions are not a good policy. We should be looking at the tariffs because it pushes trade outside of the US dollar, and we're actually observing that in the commodity space. So in terms of the oil, what are the numbers? So about 1.5 million barrels per day of oil, Russian oil, is under threat. Yes, that if indeed they're going ahead with the harsher sanctions. In the case of Iran, the market is pricing in right now anywhere lost between 700,000 barrels of oil per day to 1.3 million barrels per day. On top of that, you have some volumes, about 200,000 barrels per day of oil of losses in Venezuela potentially. So the numbers are really, really large. So the question is, who is going to backfill that? Yes, because if this is not going to happen, if there's nobody to backfill, then the balance is tightened, the price goes up, and that's exactly the opposite of what Trump is trying to achieve, substantially lower energy prices.
Well, that's what I'm curious about, too, because he does talk about trying to, I guess, boost production here. I mean, in his speech earlier at Davos, he talked about all this liquid gold beneath our feet. Is there all this liquid gold beneath our feet? I thought we've kind of tapped everything that was beneath our feet already.
Strongly disagree. So in the case of the United States, we're number one in coal reserves. We're number one in gas reserves. We're number three in oil reserves. So indeed, we have a significant amount of natural resources underground. We're actually short on metals, but it's a completely different conversation. So what is the plan? On day one, he announced, or he declared national energy emergency. He lifted all the restrictions on drilling, transportation, and refining on oil. He wants to increase production of, by energy, he means oil, gas, and electricity. So it's over-encompassing. He wants to increase production very, very quickly. But at the same time, the United States is not just in time production. Yes, all of that takes time. All of that, it's not 2025 type of a production.
So assume hypothetically that we do find a way to increase production in some meaningful way. What would the response be by OPEC and more importantly by Saudi Arabia?
So I think the question is, number one, how fast the production can increase, to what volumes are we talking about? So I think the question to ask here is, what is the equilibrium price at which level the U.S. producer feels comfortable responding? Because at the same time, they don't want to drill themselves out of business. The drill, baby, drill, all of them keep talking about dividends, buybacks, return on investment, and all those things. So we estimate that $60 price, at this level, U.S. production is flat. At $50 price, U.S. production is definitely declining. So what we believe is that what they're going to try to achieve is they're going to bring this equilibrium price lower through deregulation. Another example, 20% of the U.S. oil and gas today is produced on federal lands, and producers pay between 12 to 20% royalty. This will go down to zero. Corporate taxes, that's paid on profit, it's about 25% at the moment. That could go down to 15%. Methane emissions, all other things that are being taxed at the moment, all of that will go down to zero. So they will bring this equilibrium price down from 60 to whatever number we have at the moment. We're calculating. We can come back and discuss that next time. But that's what we believe what they're trying to achieve. So your question is correct. What are the volumes? What OPEC's response will be? So far, we've seen no indications from the OPEC that they are willing to backstop any sanctions on Iran, Venezuela, or Russia.
So what do you think is going to matter more then? Is it going to be more oil coming from the U.S., assuming that we can lower that break-even price through those measures, or the geopolitical risks?
So the U.S. oil it takes time. So even with all the deregulation, it's not a 2025 story. It's 2026 and beyond. Not only that, they're very explicit that this is within the next presidential term. Yes, it's between now and the end of 2028, and this will happen. They're working towards that. Geopolitical risks are very high, and some of that is priced in, some of that is not priced in. What we estimate today is the fair value of oil today, Brent, is $75. Today, we're trading at 78, 79, so we're trading above that. This is what is priced in at the moment. We believe actually it's the sanctions on Iran. Potentially that the market is pricing in at the moment. The rest is not there yet.
If the rest comes from Venezuela and Russia, what does the price look like?
So the rule of thumb for this year is 1 million barrels per day equals $9. So that's how we should be thinking about that.
As in that comes off the market, you add $9 to the fair value.
Correct.
Okay, so that could be material.
It's material, especially for a president who campaigned on bringing prices for the U.S. consumers significantly lower.
Yeah.
Yes, he promised to halve the prices of energy in the next 12 months. So the argument we're making is that because of that, they are not going to go ahead with the sanctions. They will try to negotiate. They will be used as a leverage, negotiating leverage with Russia, with Iran, maybe Venezuela. But the argument we're making is the lower price is significantly more important than everything else.
Natasha, great to have you. As always, I always learn a lot from these conversations. Natasha Kaneva, head of global commodity strategy over at JPMorgan. And we should point out a little bit earlier, she did mention some of the tariffs and maybe the potential impact that would have on the energy market. President Donald Trump is in the Oval Office right now, Alex, where he is actually talking to reporters, and he's talking about reiterating basically that the tariffs that he's promised for Canada and Mexico, that February 1st deadline still there. The tariffs increase that he's promising on China, that's still in play as well. And of course, he's talking about the overall effect on it as well.
Yeah, I'm really interested to see how the Canada situation plays out, because with oil, for example, we get a lot of oil that comes from Canada because they have a certain type of oil that we need versus the oil that we have here. And how that winds up feeding into this conversation we just had with Natasha will be quite interesting.
And what's so fascinating talking to her, because obviously she knows way more about this than we do, but the idea of, like, as an investor or an analyst, whatever you want to be, how do you really sort of break down the effects of all of these things all together?
Yeah, and it's going to be really difficult, too. And that's why I mentioned the ARBs, right? Because maybe you're going to see West Canadian Select, which is that heavy crude, trade at a higher premium if you get those tariffs than it would have earlier. Maybe you have a differential in the Middle East as well. Anyway, looking at a market here, still around record highs. We might make it today for the first record high of the year. One stock that's not doing well, though, Electronic Arts, Romain. Yeah, Electronic Arts. Actually, I was taking a look at this, having its worst day since 2008. Of course, I know you're a big video gamer, right? I remember, in 2008, I was definitely standing out like a Call of Duty at like noon with a camera interviewing a man on the street. All right. Well, I did not know that about you. Well, I don't know if you play EA games, but apparently there's some concerns that maybe not enough people are playing them. The company produced financial results saying that they would be lower than expected due to weak game sales, particularly in two of its main titles. Jess Menton joins us right now, who covers stocks for us here at Bloomberg. And this is a phenomenal drop. I mean, this company has had some hiccups in the past, but I mean, they still have franchise titles. It's just a matter of can they get them out the door and please the gamers who buy this stuff.
And to put it into perspective, it would wipe out about more than $6 billion in market value today with this drop alone. And to your point, because the powerhouse and what it's really built by is when you think about its soccer type games. And for context, for people who might not remember, in 2022 was when they dropped and ended their partnership with FIFA. So they rebranded. Now it's EA Sports. They have different FC. The first version they had after they dropped the FIFA branding for the 24 did very well. But 25, when it came out back in September, didn't do as well. So now you have Baird analysts saying they need to really ramp up the marketing in order to get this. Because really, when you're talking about the net bookings that missed, it was the live services revenue. So that basically means, say you're going and either physically buying the game online, or if you're buying the physical copy, there's other things you can buy after that, whether it's additional players and things like that. And that's what people weren't doing as much. So that's where a lot of that was the disappointment there, because this is the backdrop and what really helps support the profit and the outlook for this company. My question is, I thought that football was like invincible. By football, I mean soccer. No, I really thought like that was like what all the kids like. Right. Lionel Messi, he's that guy in Florida, right? Who like kicks the ball with his feet. You know what I mean? Like I thought this was like all the things. So it was really weird to see how much that disappointed. Well, there also is sort of twofold there, because you saw that weakness when it came to what was happening in that segment. But also there's another game, and this was the fourth installment for Dragon Age. But that was expected by analysts. So that also came out back heading into the final quarter of this last year. But really, I think they added about 1.5 million players, and that's 50% less than what they were expecting. And for context also, EA is not going to report their earnings until February 4th. So this is the preliminary, what they're trying to guide ahead of that report. I am curious, though, too, because when we talk about longer term and the forecast going forward, there's a lot of talk here that overall some of the games are legacy, if you will. And the idea that younger folks have kind of moved on to different types of games that are kind of outside the purview of where EA has put a lot of its eggs in terms of spending and development. And that's what the next basically looking forward is because you also had downgrades from Bank of America, you had BMO, as well as Raymond James. And so that was kind of Baird's point as far as the marketing and how are you going to get more people to this, and what other versions beyond soccer are they going to get more people to come in and buy these types of games?
Do you play these games at all?
I actually was more of a Super Nintendo, Mario kind of Sega person when I was a kid.
Yeah.
Zelda, Legends of Zelda.
Legend of
Right?
Zelda. Yeah.
Huge.
Yeah, I don't even want to tell you what games I play because I'm old.
What games do you play?
It was like,
Although I love
it was like
Pac-Man.
Pitfall, Qbert, so yes, I'm that old.
No, I like Pac-Man though. Talking about old.
I mean, I had an Atari 2600 when my first console, so yes, I'm that old, Alex.
That doesn't really mean anything to me, but thank you for sharing.
Exactly.
To the point, Electronic Arts down by about 17%. All right, Jess, thanks a lot. We really appreciate it.
Space Invaders.
Yeah, we want to take it now to Washington, D.C., where President Trump has just signed executive orders related to artificial intelligence, as well as an action to declassify the JFK murder file. Oh, yeah, we're going to take you to that right now.
Okay. Thank you. And this, David, is?
Yeah, this is the crypto EO. We're going to be forming an internal working group to make America the world capital in crypto under your leadership.
Which is really going up, right?
Absolutely.
All right, David, that's for you. Thanks, sir. You find them exciting? They might not be exciting, but we're going to make a lot of money for the country.
Thank you, sir.
And so is David. You have to check him out. There's nobody like this guy. They said, how did you get David Sachs? How did you do that? And he's doing it for the country more than anything else. So we appreciate it, David. Thank you very much.
This is an executive order establishing a presidential commission, an advisory commission on science and technology.
Good. Do you want to explain that a little bit?
The basic idea is to get together top people from government, the private sector, technology industry, as well as educational institutions, to make sure that America maintains its leadership position with respect to science and technology development in the years ahead.
Good. That's great.
Next, sir, we have a presidential memorandum encouraging departments and agencies in your government, including the Department of the Interior, to promote federal recognition of the Lumbee tribe of North Carolina.
I love the Lumbee tribe. So this is their first big step, right?
This would be a huge step for them, sir.
Yeah, they were with me all the way. They were great. North Carolina, Lumbee tribe. Okay, you'll send them a copy of that?
Yes, sir.
They were great. Okay?
And if you'd like, I could get them that pen, sir, as well.
Yeah, let's do that.
Next, we have a set of pardons for peaceful pro-life protesters who were prosecuted by the Biden administration for exercising their First Amendment rights.
Do you know how many?
I believe it's 23, sir.
23 people were prosecuted. They should not have been prosecuted. Many of them are elderly people. They should not have been prosecuted. This is a great honor to sign this. They'll be very happy. So they're all in prison now.
Some are out of custody.
It's ridiculous. Okay?
Lastly, sir, we have an executive order ordering the declassification of files relating to the assassinations of President John F. Kennedy, Senator Robert F. Kennedy, and the Reverend Dr. Martin Luther King Jr.
That's a big one, huh? A lot of people are waiting for this for years, for decades. And everything will be revealed. Okay? Give that to RFK Jr.
Yes, sir.
Okay? Okay, thank you very much.
Mr. President, a U.S. judge temporarily blocks the birthright citizenship order. Do you have any reaction?
No, obviously we'll appeal it. They put it before a certain judge in Seattle, I guess, right? And there's no surprises with that judge.
Mr. President, Senators Collins and Murkowski have now said they will vote against Pete Hegseth. Are you worried about his confirmation and your reaction?
No, and no surprises there. It's too bad. You know, it's just the way it is. Too bad.
And when would you adjourn Congress to make recess appointments, Mr. President?
Well, I'd take a look at that. I'd listen to John Thune. He's doing a fantastic job. We're moving along. The Democrats are trying to delay government, as they always do. They can't help themselves. Even John Ratcliffe, who's very, very strong, very popular, and liked by the Democrats. I guess he gets a lot of Democrat votes. That's taking a long time, and it shouldn't be taking a long time. They're maxing everything out so they can delay everything as much as possible.
Does Senator Thune support an effort to use recess appointments if you choose to do that?
I'd be willing to use recess appointments. It's up to John, and we'll see. John Thune's a great guy, great senator, knows his stuff inside out and backwards, but I would use recess appointments if he wants to do that. Absolutely. The Democrats are just delaying. They always delay.
Mr. President, you spoke with the Saudi Crown Prince yesterday.
Who?
The Saudi Crown Prince. How was the call?
Right.
And they said $600 billion they're going to invest.
600. I'll ask them for $1 trillion.
You said you're going to ask them for $1 trillion. Will Saudi Arabia be the first foreign country you will visit since they invest in that much money?
Well, if they do that, I would, yeah. I would be glad to do that. I did it, as you know, 4 years ago. We did $450 billion, meaning the money all goes to American companies, and they purchase jets and they purchase computers and everything else. And we did $450 billion, and I guess we're at 650. And I'll see if I can talk him into it.
I don't think it is again. You showed great confidence in Steve Witkoff. Why you said that you doubt that the ceasefire in Gaza will hold, since you appraised his
Well, no, I think he's
efforts?
great, but it's a very tricky place. It's very tricky. We'll see. And if something does happen, they will not be happy.
Sir, follow up on that one. In terms of Steve Witkoff, are you going to put him in charge of Iran's strategy, and do you want him talking directly with the Iranians?
No, but he's certainly somebody I would use. He's done a fantastic job. He's a great negotiator. He's a very good person, a very popular person. Gets along with people. I have great negotiators. They have no personality whatsoever, and then I have some that do. Steve has a wonderful way about him, and people like him, and even in this case, both sides like him. And he was able to make a deal. That deal would have never been made without Steve. The Biden people couldn't make the deal. They were working on it for a year and a half. They couldn't make a deal. We got it done prior to the inauguration. We said it has to be before the inauguration. I mean, the deal should hold, but if it doesn't hold, there'll be a lot of problems.
Related to your AI, EO, just hours after you made that big Stargate announcement, Elon Musk tweeted that they don't actually have the money. Is that true?
I don't know if they do, but they're putting up the money. The government's not putting up anything. They're putting up money. They're very rich people, so I hope they do. And I mean, Elon doesn't like one of those people, so you're allowed to.
Are you worried that AI is going to replace many American jobs?
No, it's going to create tremendous numbers of jobs. It's going to also create a lot of benefits medically for cancer research and other things. It's going to have a huge positive impact. And, we want to be ahead of China. We're right now way ahead of China. David Sachs is one of the all-time experts. That people are amazed that you just met him. I don't know if he's still here. There he is. But one of the most respected people in that world. It's a world. It's a whole different world. And we're ahead of China now because of what I'm doing. And I think it's going to be very successful.
Mr. President, please, you just asked the Davos Forum again that NATO countries should spend 5% of GDP on defense.
Yeah.
The United States don't spend 5%.
Well,
Do you think
I
it should
don't
also
think so.
apply to the United States?
We're protecting them, They're not protecting us, we're protecting them. So I don't think we should be spending, I'm not sure we should be spending anything, but we should certainly be helping them. But they should up their 2% to 5%, yeah.
Mr. President, you said earlier during your speech at Davos that you would like to see interest rates come down. How much would you like to see them come down?
A lot.
And will you talk
I'd
with
like to see them come down a lot, and oil prices will come down. And when oil prices come down, everything's going to be cheaper for the American people and actually for the world, but for the American people. So I'd like to see oil prices come down. And when the energy comes down, that's going to knock out a lot of the inflation. That's going to automatically bring the interest rates down.
Are you worried that there's too much going on?
You said that you would demand.
Are you worried that there's too much going on at once if you're trying to bring interest rates down, get the economy back going?
No, it just works that way. I mean, it's just economically works that way. When the oil comes down, it'll bring down prices. Then you won't have inflation, and then the interest rates will come down.
You said that you would demand that the interest rates come down.
Well, I would.
Do you expect
I would put in a strong statement.
Do you expect the Fed to listen to you?
Yeah.
Are you going to talk to Powell about this and bringing the rates down?
At the right time, I would.
Sir, do you believe any of the people you pardoned that were participated in the January 6, 2021 attack? Do you plan to meet with any of them or meet with them at the White House?
I don't know. I'm sure that they probably would like to. I did them something important, but what they did is they were protesting a crooked election. I mean, people understand that also. And they were treated very badly. Nobody's been treated like that. So I'd be open to it, certainly. I don't know of anything like that, but I think they're going to meet in some of the congressmen, women, want to meet. But I'd certainly be open to it.
Have you spoken to them since you issued the pardons?
I haven't spoken to any of them yet, but I know they're very happy.
Mr. President,
I gave them their life back. Their life was taken away from them unnecessarily and unfairly. I gave them their life back, so I can imagine they probably would like to.
Mr. President, what did you mean when you said that Biden took bad advice and not pardoning himself yesterday?
Well, he did. I think he did, because he pardoned all these people that are crooked as hell. Look, the congressmen, they're crooked. What they did is they destroyed evidence. When you destroy evidence, especially criminally like that, they did it criminally. And the reason they destroyed the evidence is because it proved that I was right. They didn't destroy evidence for no reason. They destroyed it because they found many documents saying that I offered 10,000 soldiers. If they had 500 soldiers or National Guard, there would have been no problem. If they had 200, that would have been. I offered 10,000 if they needed them. There would have been no problem. That's been now totally disproven. And it's also been disproven by Nancy Pelosi's daughter, who has her on tape saying it was her fault, that she has full responsibility for this. And they have all that stuff. They destroyed everything. And they go through a year and a half, 2 years of nonsense. They come up with tremendous evidence, and they destroyed evidence. And Schiff knew about it. That's why he's on there. He knew all about the destruction of evidence. A lot of people said he's the one that got him to do it. And he's a crooked guy, totally crooked politician. And so he's pardoned, and some other people are pardoned. And these are crooked politicians, every one of them. Benny Johnson, what he did is incredible. I mean, he was the leader of the committee, and he did it. Cheney, crying Adam Kinzinger, all of them. They destroyed evidence and deleted everything. There's nothing. There's no evidence now. They're crooked politicians, and they should be punished. If that's even in a civil trial, you go to jail for a thing like that. They destroyed every document, from what I understand, every document, because it proved that I was totally innocent.
Mr. President, to send up to 10,000 troops to the southern border, sir?
Yeah. Oh, southern border?
Yes,
when
the
you
border.
say southern border, when I said 10,000 troops, I was referring to the capital.
Oh, I see. And when do you plan to do that?
I offered 10,000 troops for the capital before January 6th.
And as for the 1,500 at the southern border, sir, to clarify, what exactly do you want them to be doing right now?
Making sure that the border is safe and secure, and that criminals don't come into our country.
Mr. President, do you think that sanctions on Russia will force President Putin to negotiate?
I don't know, but I think he should make a deal.
Mr. President, does it bother you that Elon Musk criticized a deal that you made publicly, that he said that he tweeted that?
No, it doesn't. He hates one of the people in the deals.
Have you spoken to him since then?
No, I've spoken to Elon, but I've spoken to all of them, actually. No, the people in the deal are very, very smart people. But Elon, one of the people he happens to hate, but I have certain hatreds of people, too.
Sir,
you know?
Sir, on China, what do you think Xi Jinping can do on the Ukraine-Russia war?
Which one?
The Ukraine-Russia war. What can Xi Jinping do about that?
China?
Yeah.
They have a lot of power over Russia. They supply energy to Russia. And Russia supplies energy to them. They supply other things to, it's really a very big trade. It's a very big trading partner. But Russia supplies a lot of energy to China. China pays them a lot of money for that. And I think they have a lot of power over Russia. So I think Russia should want to make a deal. Maybe they want to make a deal. I think from what I hear, Putin would like to see me, and we'll meet as soon as we can. I'd meet immediately. Every day we don't meet, soldiers are being killed in a battlefield. And that battlefield is like no battlefield since World War II.
You said that Ukraine wants
and I have pictures that you don't want to see. Soldiers are being killed on a daily basis at numbers that we haven't seen in decades. And it would be nice to end that war. It's a ridiculous war.
You said that Ukraine's ready to make a deal. Did President Zelensky tell you that personally?
Yeah, sure. He's ready to negotiate a deal. He'd like to stop. He's somebody that lost a lot of soldiers, and so did Russia. Lost a lot. Russia lost more soldiers. They lost 800,000 soldiers. Would you say that's a lot? I'd say it's a lot.
Mr. President, you said that you wanted to make Dr. King's dream a reality. What's your response to his children and civil rights leaders who say that your DEI orders are a contradiction of his dream and could further drive racial disparities?
Well, I haven't heard that.
Mr. President, you put the Houthis back on the terror list. How do you see the war in Yemen end?
Well, we'll see what happens, but they can't shoot down our ships, the Houthis.
Yes.
And you can't shoot down our ships or any ships, and that's what they've been doing. So they're on the terror list. That's not good for them.
So why did you revoke security protections for former Secretary of State Mike Pompeo and Brian Hook?
Well, the same reason I did. When you have protection, you can't have it for the rest of your life. Do you want to have a large detail of people guarding people for the rest of their lives? I mean, there's risks to everything.
So would you support striking Iran's nuclear facilities?
Say it.
Would you support Israel, for example, striking Iran's nuclear facilities?
Well, I'm not going to answer that. Obviously, I'm not going to answer that question. We'll have to see. I'm going to be meeting with various people over the next couple of days, and we'll see. But hopefully that could be worked out without having to worry about it. It would be nice. It would really be nice if that could be worked out without having to go that further step.
And who are you going to meet with?
Well, I'd rather not say that, but very high-level people. But hopefully that can be worked out. Look, Iran hopefully will make a deal, and if they don't make a deal, I guess that's okay too.
And Mr. President, just to follow up, you said you think the Fed should listen to you. Can you elaborate on why you think it should?
With regard to interest rates?
Correct, yes.
Because I think I know interest rates much better than they do. And I think I know it certainly much better than the one who's primarily in charge of making that decision. But no, I'm guided by them very much. But if I disagree, I will let it be known.
So your tariffs plans for China and Mexico are much tougher. Or the ones for Canada and Mexico are much tougher than the one for China. Why is it softer for China?
Well, China's already paying a lot of tariffs because of me. And when you add them up, I would say, they're paying a lot. They've paid hundreds of billions of dollars. They never paid 10 cents until I came along. When I came along, they've paid hundreds of billions of dollars. Never paid anything. And so they've already started at a higher base.
Is February 1st the date for Chinese tariffs as well, sir? February 1, or was that just Mexico and Canada?
It's Mexico and Canada, but we're talking about China too. Look, China's sending us tremendous amounts of bad drugs, fentanyl, really bad stuff. Most of it comes through Mexico. and we're losing, I think, 300,000 lives a year because of that. People say 150, 100, 120. I think 300,000 lives a year. Those are old numbers. The lower number is a low number, and we can't have that. They've got to stop sending it. I had a deal with President Xi, but it was a deal that wasn't followed up by Biden, of course, where they were going to issue the death penalty to people that make fentanyl, and that would have stopped it. But we'll have to stop it with tariffs. Okay, thank you very much, everybody.
All right, guys. Thank you, Mr. President.
Thank you, Mr. President.
Thank you, guys. Hey, press, let's go. Thanks, guys. Nope, guys, let's go. Thank you, guys.
We were just listening to the President of the United States in the Oval Office. That is tape playback. He had spoke a little bit earlier on a wide range of issues. Of course, talking about tariffs, talking about his relationship with Putin, and more importantly, talking about his shepherding of the economy. As for financial markets, well, they're doing well. A close at a record high for the S&P 500, the first close above 6,100 in its history. Romaine Bostick here alongside Alex Teal and Scarlett Fu. We have earnings also breaking right now as well. I think we should get to those as well. Texas Instruments and CSX, guys, crossing the wire.
Yep, taking a look at Texas Instruments here. In terms of earnings per share, it looks to be a nice solid beat, including their expectations that they had back in the third quarter, coming in at $1.30 a share. Also, revenue coming in a little over $4 billion. However, this does mark the ninth straight quarter of revenue decline. So that also part of the stock. Now, taking a look at the first quarter in terms of estimates on the high end, looking at the revenue of about $4.06 billion, guys.
All right, let's take a look at CSX. This is a railroad company. Fourth quarter EPS 38 cents, missing the consensus estimate of 42 cents. Revenue of $3.54 billion, also coming in a bit lighter than anticipated, which was $3.57 billion. Operating income also shy of the Wall Street estimate, $1.11 billion for the fourth quarter.
All right, we go back to the broader market and that record high on the S&P 500 with all of the S&P sectors in the green on the day. Michael Cuggino, president and portfolio manager of Permanent Portfolio Family of Funds, joins us right now here on this record day. Michael, you've seen this rally. You know what's been propelling it. Do you buy into it tomorrow?
Depends on what sectors you're talking about, if it's equities. The broader market is trading, per our estimates, at about a 22 multiple right now, which is, historically rich. And certain sectors are even above that. So I think if you want to buy stocks, you're looking at areas that haven't kept up. You're looking at sectors that haven't kept up, but that have a lot of, longer range potential and probably a dividend component. So you're looking at a total return type situation.
So what kind of sectors are you talking about, or is this a specific stock by stock basis?
Well, broadly speaking, we've been looking in the energy area lately, the materials area, that have had a good start to the year, but still probably lagging and a long way to go to catch up to maybe some of the other sectors like tech. I think financials to some degree. I think transports are interesting. So some of those names that are more broader economic activity, hopefully on the expectations of an animal spirits economy coming back at some point. And so that would be an area where we look. We don't dislike tech or some of the other pricier areas, but it's I just wouldn't be buying them here. I'd be waiting for a pullback.
All right, and perhaps we'll get that with the earnings next week. What about small caps, Michael? Because they are seen as the beneficiaries of the Trump trade, and they did start this year outperforming their big cap peers, but that's no longer the case. Their performance is kind of right in the middle.
Yeah, our process looks at an all-cap strategy, so smalls, mids, and larges. So definitely they would be in the mix under that area. Small caps have been probably what I would characterize as somewhat lagging. So that is definitely an area to play. For us, you need to have enough scale to invest in enough of it to move the needle in terms of portfolio performance. But smaller caps, definitely in the right circumstance, would be of interest to us in a variety of industries, because as a capitalization play, they have not kept up.
We're in conversation with Michael Cuggino. More earnings crossing the wire right now. This on Intuitive Surgical, ticker ISRG. The company reporting fourth quarter adjusted EPS above street estimates, $2.21 a share. The street was looking for $1.81. Revenue coming in above estimates as well at about $2.41 billion. The company guiding on gross profit margin and procedure growth for 2025 coming in slightly higher than estimates. Back to Michael Cuggino with the Permanent Portfolio Family of funds, still with us here. And Michael, I do have to ask you here about the political backdrop. We coming into what is now basically day 3.5 of the Trump administration. He's made his presence felt. Of course, we've seen that with the disruption to our show today. Should that be a disruption for investors as well, or do you look through it?
No, I think the equity run has been based on the election, based on an expectation of lower taxes, lower regulation, more, like I mentioned, more animal spirits coming back. I mean, obviously, we don't know what's going to happen, and I would call us cautious optimists. We hope the market's right, and we hope that this continues. But keep in mind, the market bled up all of last year, and it's currently rich. So a consolidation, a correction, or whatever, regardless of economic circumstances or politics, wouldn't be out of the question here. And then you do have to look at, I mean, our view is that there are certain risk factors out there that regardless of who won the election, we're still not going to go away right away. And they're going to take time to iron out and answer those questions. Geopolitically, there's a lot of risk around the world. Global growth is not really all that strong right now. Interest rates, higher for longer, whether it's in the U.S. or potentially other places. Inflation seems stickier than maybe people were hoping for. And so, and some, data points have looked a little weak in the U.S. economy, loan provisions and delinquencies, some job softening in some areas. So, I mean, we're not without risk. And I think the prudent investor wants to consider investments to account for that, as well as maybe wanting to participate in the stock run.
Michael, appreciate you joining us. Michael Cuggino, president and portfolio manager of the Permanent Portfolio family of funds, helping us break down all of today's market action. Alex Seal will be back tomorrow. Scarlett Fu sticks around. Hopefully you'll stick around as well as we take a deeper dive after the break into some of those earnings crossing the wire. Stuart Kaiser, head of equities trading strategy over at Citi. He's on deck. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. A record day for stocks, at least for the S&P 500. We've been waiting to get back to that 6,100 level. We had it on an intraday basis the last couple of days. We get it on a closing basis today. 0.5% on the S&P 500. Just maybe about an hour ago, it didn't look like we were going to get it, but we did see a surge of activity heading into the close. All of the S&P sectors finishing the day in the green. Utilities, materials, and a lot of those industrial names, though, Scarlett, were leading the charge.
Absolutely. Let's start with GE, which was one of the big gainers of the day, climbing to a record high. This is now, of course, GE Aerospace. It's a jet engine maker after it split up into different parts, and it reported sales and profit that beat analyst estimates. However, American Airlines, which is tied to GE, of course, down 8.7%, surprising investors with a disappointing forecast for this quarter, which stood in stark contrast to bullish outlooks from Delta and United. American dealing with trying to win back the business customers that it had lost and trying to get its costs under control. And our final mover here is Electronic Arts, losing about 17% on the day, the worst performer in the S&P 500 after it pre-announced a decline in bookings tied to its soccer video game. But our top story this hour really comes back to something that we've been talking about this week and for a couple of weeks now, which is the Trump effect. You see it in oil futures today, which fell after the president urged Saudi Arabia and other OPEC nations to lower prices. Corporate leaders like Brian Moynihan are feeling it after Trump accused Bank of America of limiting business with conservative clients. And investors, well, they're celebrating it following this week's AI infrastructure commitment by SoftBank, Oracle, and OpenAI. We're going to examine all of this later on in the program.
Yeah, John Koudounis over at Calamos is going to be joining us. He has a lot of thoughts here on Trump's impact on financial markets and the economy. But let's take a closer look at, well, the impact of earnings on financial markets and the economy. Around 15% of the S&P 500 by market cap have already reported earnings, and the early results show the largest portion so far beating estimates. Stuart Kaiser, head of equity trading strategy over at Citi, joins us now here in Studio 2. Next week going to be even busier. We get about 100 S&P companies reporting. Are you encouraged so far by what we've heard?
Yeah, I think we're relatively encouraged. I mean, when you enter a year at the valuation levels we're entering the year at, you really need earnings to kind of deliver. And I do think the quarter has kind of started off similar to the last few quarters, which is a lot of idiosyncratic risk. You highlighted Electronic Arts and American Airlines down, and then you have some other stocks really up. I mean, earnings the last few quarters have been very large moves that actually outperformed the options implied move, a lot of volatility, but generally an upward bias. And I think that pattern is kind of what we're seeing. To your point, next week, particularly at the back end of the week, we get large cap tech. And, those earnings are, kind of a must have, given the amount they contribute.
Well, those are the ones I was kind of going through them. I mean, we get Tesla, Microsoft, Meta, relatively consistent in terms of their earnings, but you get a few wild cards in there: Intel, UPS, Starbucks, and even Apple, which of course has a huge weighting. And I mean, who knows what to expect? There's been so many kind of chatter about how their iPhone sales are doing or maybe not doing. If those companies, those bigger weighted companies, and the companies that have kind of really propelled the latest bull market, if they don't show up for the party, is that the end of the rally?
Well, I mean, I think it's a significant risk to the market. I mean, if you look at S&P EPS forecast at about 15%, that Mag 7 is forecast to grow earnings low 20s, right? So not only do they have to deliver, significant enough earnings to kind of, drive the market higher. The tech sector, 20% of earnings, 30% of market cap, right? So this is a part of the market that really punches above its weight in terms of the impact on markets. So yeah, it's vital that those companies, kind of keep the ball rolling, I would say.
Within the tech sector, looking at semiconductor companies, are they delivering? Because you heard what SK Hynix said about, spending on AI maybe not coming in as well as many people had hoped, and ASML declining today. Texas Instruments showing that the chip slump is persisting. This could be something that perhaps it's not completely priced in right now.
Yeah, it could be. And I think on that line, Scarlett, that's why, your Meta, your Google, and your Microsoft are so important. And what do they guide to CapEx spend, particularly on data center? Because a lot of that kind of flows through to a lot of these chip stocks. The fact is, within the semi space, you have the AI part, which is a huge bull market, but the memory part is a little bit lagging. So I think what you're seeing with some of these stocks is if you don't really deliver or have a large portion of your growth coming from AI, then there's a pretty high bar for you in terms of what you deliver on your core business. And I think that'll likely continue. I mean, AI is all the rage right now, right? So.
It is, certainly. But what's been surprising is how a lot of legacy names, old school names, have started to make their way into AI. Oracle, for instance, being a good example, right? No one necessarily thought of it as an AI play, but increasingly it's become one. How do you think about dividing the line between old school tech versus the tech that's now involved in AI?
Yeah, it's really tricky. And I think that AI trade has frankly evolved quite a bit over the last couple of years. There was a point where if you mentioned AI as part of your business plan, you rose. Last year, that wasn't the case. Last year, you had to demonstrate that AI was an investment that was going to pay off in terms of ROE or revenue growth over sort of investable horizon. So I think for some of these companies that are maybe sort of late joiners, they need to really prove that those investments are going to pay off and deliver. Otherwise, I think investors are going to be kind of skeptical, which is, I think, another reason why that power generation, for instance, has become such a popular trade, because that's the picks and shovels of AI. I don't have to take your word for it that 8 quarters out you're going to deliver earnings. It's very visible. And I think with the AI trade, the bar's gotten a little bit higher right now. There needs to be a little more visibility around what your business is and how it's going to pay off for companies to kind of buy into that trade.
It's interesting with the AI trade and all the talk around that. That seems to be more a conversation about business spending. I am curious about what opportunities there are in the market right now for companies that are much more consumer spending focused. Is there hope there?
There is, but it's definitely kind of a risk point, right? I mean, if you ask me from a macro perspective, what's the single biggest risk to the markets? It would be that the unemployment rate kind of ticked higher, right? And that would be a headwind for those retail companies. A lot of the retailers also have a little bit more exposure to tariffs, because of where they import from, a lot of imports from Asia. So I would say the economic data has been positive. Consumer spending looks strong. The banks are talking about, solid credit trends and solid loan growth. But the risk there would be, do you get an inflection point higher unemployment, and do you get a more aggressive tariff approach, from the administration that kind of weighs on their profitability forecast going forward?
All right, Stuart Kaiser, head of equity trading strategy at Citi. Thank you so much for giving us your insight into earnings season thus far. Some breaking news crossing while we're speaking with Stuart. JPMorgan Chase has boosted its CEO's pay. Jamie Dimon's pay goes to $39 million from $36 million. So this is total pay, Romain, for 2024, $39 million.
Yeah, relatively incremental, of course, given the price point that he was already at here. So you reward the guy. And of course, we should point out, he's sitting on a lot more money than that, than the shares. Kind of like one of the first billionaire CEOs that wasn't actually a founder of the company that he was actually running there. A lot more coming up here, including a focus on the interest rate market. Michael Pond going to be joining us, head of global inflation at Barclays, his outlook for the U.S. and the broader market. This is The Close on Bloomberg.
just under 1 week away from next week's Fed decision, and markets are pricing in 1 to 2 rate cuts this year due to uneasiness from some Fed officials that inflation is still uncomfortably high. Joining us now for more on this is Michael Pond. He is head of global inflation over at Barclays. So in addition to scrutinizing every piece of data that comes along, everyone's fixated on what is and isn't in these early executive actions and policy announcements from the Trump administration this first week, including folks over at the Fed. Is there enough substance for Fed economists to start modeling scenarios around here?
Not yet, Scarlett. So I just came back from our 20th annual conference focused on inflation and macro issues. And one of the key themes there was the uncertainty in the Fed outlook, driven by the inflation outlook, which was really almost solely driven by the outlook on tariffs. And the swing in inflation forecast in the uncertainty in tariffs goes over 100 basis points. Wow. We could get inflation higher by over a full percentage point because of tariffs, or as we basically did in Trump 1.0, we could get no impact on consumer price inflation from targeted tariffs.
So I think about what we saw today, right? Everyone's focused on what he does rather than what he says, but what he says moves markets. And we saw it with him urging OPEC to lower oil prices. And he also explained that if you lower oil prices, that will lower inflation expectations and therefore lower inflation overall. And people in the market interpret that to mean lower bond yields. You see the 2-year yield coming in. How much credence do you put into that kind of narrative that comes out of that knee-jerk reaction?
Well, if inflation is lower and it's expected to be sustainable, then the Fed might act and lower rates more than expected. Oil prices probably won't do it, though, Scarlett. And the reason is the Fed is looking for underlying inflation trends driven by mostly core measures or super core driven by the labor market. So if we start to see a bit of labor market cooling, if we start to see shelter inflation really come down, core goods prices inflation soften, then the Fed might act and really remove tight policy. But it really takes more than oil or food prices. It's the underlying trend that the Fed is watching.
I want to stop on your comment about the Fed acting, because we have to talk about the elephant in the room, and that is the president, who's made it clear he's in charge. He was asked just a few minutes ago about Jay Powell, and he made some comment about how he knows more about rates than Powell, and he'll talk to Jay Powell whenever he's ready. I do wonder, I know the line that's going to come out of the FOMC is that, we just focus on the data and do our job. There's going to be pressure on Jay Powell to keep rates low, at least if you believe what the president says. And I wonder if that's going to complicate any potential fight against a resurgence in inflation that the market might be primed for.
So in the near term, I don't think so. But you have a very good point that Jay Powell will not be around forever. Next year, we could see a change in the Fed chairmanship. So next year, this rhetoric becomes quite important.
What's the conversation, though? They start this meeting on Tuesday, this two-day meeting. And I know they always say, look, we just kind of wait for what happens and then we react to it. We don't try to front run it. I don't believe that, but that's what they say. I do wonder what the conversation is going to be behind closed doors as to how they position their policy, or at least their communication of policy, in anticipation of whatever changes might come because of those tariffs.
So first of all, I don't think politics is on the table for discussion as an influence on monetary policy, at least not today. But the direction of inflation certainly is. We've seen some weaker inflation prints. That gives them some cover, some room to talk about cuts. But again, there's a lot of uncertainty. As much as I've talked about clients and investors having that uncertainty of tariffs, the Fed doesn't know any more than we do.
Yeah.
What are your clients thinking? I mean, what's the number one question they're asking you?
So beyond inflation, there were a couple other themes that came out of the conference. One is U.S. exceptionalism. When it comes to growth, the growth outlook on its own, that we continue to get very strong growth in the U.S., but also especially relative to Europe and relative to China. In addition to uncertainty, the other was just a general concern over China in a number of different areas. The growth outlook for sure, but also the inflation outlook and whether negative trends in China's PPI, CPI flow through into global disinflationary pressures.
I do have to ask you, though, Michael, how you sort of fold in the outlook for consumer spending. I mean, we talk about the tariff impact, but it's kind of, I feel like the consumer spending side of it, at least the way we're perceiving it, almost seems divorced from that conversation. Is there a connection?
Well, there would be a connection down the road. So if you look at growth forecasts for 2026 or even inflation forecasts for the end of 2026, you start to get economists forecasting a negative hit to the consumer that eventually slows down growth and takes inflation down with it. So yes, you get a pop up in inflation later this year, but as we look into 2026, 2027, it could be a negative growth story.
You mentioned U.S. exceptionalism, and that kind of matches the vibe over at Davos, where Lisa Bromwitz was talking about how people from America were very optimistic. Those from Europe were kind of bummed out, even depressed, you could say, while China barely registered as being there. And that kind of sums up the investment appeal of each of those regions as well.
I think that's right. I think the investors continue to focus on U.S. growth, the Fed, and as we discussed, policy. That is what's really driving markets here.
All right, great stuff as always. Michael Pond, head of global inflation over at Barclays, as he was speaking, more earnings crossing the wire, this time on Twilio, of course, the backbone of most of our internet infrastructure. The company not expected to report earnings until mid-February. It's out with preliminary results, and they are good. The company saying that in the fourth quarter, revenue grew by about 11%. We should point out that the street, on average, was modeling for about 8% growth in that quarter. The company also saying it's targeting GAAP operating profitability for full year 2025 and at least $3 billion of cumulative free cash flow 2025 through 2027. A $2 billion buyback program not hurting either.
Yeah, this company is due to report earnings on February 13th. So this is a positive pre-announcement. It's boosting the stock by 8.5%. Twilio also expects 2024 free cash flow within its guidance range, anywhere at least $3 billion cumulative free cash flow from 2025 through 2027.
All right. Of course, one of the big movers here in the after hours trade. More news crossing the wire, this time on Walt Disney, this time on Bob Iger. His pay for the most recent year, $41.1 million. That's a raise of about $10 million. He got $31.6 million in the previous package, so a $10 million bump for Bob Iger over at Walt Disney. Stick around, a lot more coming up, including a conversation about the Trump presidency and the impact on financial markets and the economy. John Koudounis over at Calamos, he'll be joining us after the break. Stick with us. This is The Close on Bloomberg.
I hope you start opening your bank to conservatives, because many conservatives complain that the banks are not allowing them to do business within the bank, and that included a place called Bank of America. They don't take conservative business. And I don't know if the regulators mandated that because of Biden or what, but you and Jamie and everybody, I hope you're going to open your banks to conservatives, because what you're doing is wrong.
Mr. President, I'll say that your friend Gianni said hello, told me to tell you hello, and we look forward to sponsoring the World Cup when it comes, both this summer for the club and next year. So thank you for getting that for the United States.
Thank you very much, Brian.
The President of the United States addressing the Davos elite, and a funny moment there between Bank of America CEO Brian Moynihan and the President of the United States. And really just a reminder, quite frankly, of who's in charge. Love him or hate him. The bottom line is here, he is going to have a big impact on what corporate CEOs do. He's going to have a big impact on the economy and an even bigger impact on the market. We're going to talk about that in just 1 second. But I do think we need to get to some breaking news, Scarlett.
Yeah.
Crossing the wire right now on Boeing.
It's Boeing, and it's a preliminary results because Boeing doesn't actually report formal results until next week. But what we can tell you is that fourth quarter revenue came in below analyst estimates, $15.2 billion for the fourth quarter. Analysts were looking for somewhere in the neighborhood of $16.75 billion. Preliminary fourth quarter GAAP loss, a share of $5.46. So a loss of $5.46 a share on a GAAP basis. Fourth quarter adjusted free cash flow, $15.2 billion. The estimate here was for a negative $4.15 billion. So I guess that's a positive read here. And a bit of an outlook here for the fourth quarter. Fourth quarter is the revenue that was reported for that period. reported a negative operating cash flow in the period, $3.5 billion. Analysts were looking for negative $3.62 billion.
All right, we're going to dive a little bit deeper into those preliminary results once we get a little bit more information on it. But we do want to get back to our conversation here about the broader markets and really the strategies investors are taking here in what is the start of a new era in Washington and for financial markets. John Koudounis joins us right now. He's the CEO at Calamos, joining us here in New York in Studio 2. John, great to have you.
Nice to be here. Thank you.
Let's talk about it here, because we talk about the opportunity here, and we've seen the rally in stocks since the election, maybe kind of petered out a little bit since inauguration, but a lot of people are looking for opportunities, and I am curious as to where you kind of see the puck going in terms of being able to make money in this market.
Well, I think clearly the administration is pro-business, so that's very, very helpful. And I think some of the policies, if we can get done, will be very helpful. We're seeing that, as you said, in the markets. They've been very, very positive. And there's a lot of opportunities here that we see. A lot of it is in some of the legislation that he's doing in terms of easing up regulations, especially in crypto, for instance. That's a big thing. AI, the investments that they're making in the United States, trying to bring jobs back to the States. So there's a lot of opportunities and a lot of ways where people can make money.
I've lost track of how many executive orders he's signed, but I think right now it's at least over 30. But buried in those, there were a couple on AI. There was also a couple on crypto, and I know you and your folks over at Calamos have waded deeper into the crypto space.
Sure. Crypto has been the best performing asset in the last several years. Problem is, it's very volatile. And so a lot of people have been scared to get into it. Because you can lose a lot of money. There's been a couple of years where you've lost a ton of money, actually 3 years. And there's other years you can make a lot of money. So at Calamos, we're known for being great risk managers for the last 47 odd years. So we took our knowledge and options from being the largest convertible buyer in the United States and put it into the crypto market. So yesterday we launched our first 100% protected Bitcoin ETF. So what does that mean? If you bought yesterday or a time during, when the options were set, you could hold it for a year, and the cap rate was 11.65. So you get the 11.65 of the upside, and if crypto falls, you never lose money if you keep it for that time. And it trades every day during that period, and it's close to the NAV.
Is this meant to be a buy and hold product or something that people come in and out of?
No, you can come in and out of, because during the opportunity, let's say crypto falls, you can buy again at a price where you're protected. If it goes up, we have a series of different that you can buy into other series. For instance, in February 4th, we're going to launch 2 more. One's going to be 90% protected, so you can lose up to 10%. But we're thinking the cap rates are going to go up as high as 30%, and then 80% protected, where the cap rates are going to probably fall between north of 50 to 55%. So you can dial in the risk that you want on this product.
Okay, so you can customize it depending on what kind of protection you're looking for. Who do you anticipate as the audience for this product? Is it the institutional investor or is it a retail investor?
So I think the ones that have a little bit more risk appetite, like the 80%, we see that being really appealing to the institutional. So a lot of people can buy straight Bitcoin or the ETF, and then maybe they've made a lot of money and they want to dial back some of the risk, so they'll put into this. Now, the 100% protected is some of the senior citizens that cannot lose any money, will not lose any money. It's a great opportunity to participate in something that they probably were scared of doing in the past, and now they can say, well, I can't lose. I'm going to buy some of this and participate in some of the upside. 11.65 is not bad, especially when you're looking at money market rates, which are less than half of that. So it could be used as a money market alternative, especially if you're bullish on Bitcoin. And looking at what the administration is going to do now, with the new committee and everything, it's hard to say that you won't be. But volatility will still be there for sure. It's not going to go straight up. It's not going to go straight down. So that's why it's good to risk manage it.
Well, speaking of the administration, I do want to get your thoughts on some of the other areas of the market, particularly when it comes to tech and AI, because the president, of course, on Tuesday talked about as much as a $500 billion initiative involving some of the big AI players, and more executive orders came down today, kind of loosening up the regulatory oversight, which maybe potentially accelerates what has already been a pretty hot trade.
There's no question that's going to help, and less regulation is always helpful for business. I'm not saying that the regulation is not good. There needs to be some regulation, but when you're really bogged down with a lot of bureaucracy, and there was a lot in the last 4 years, it's hard to get some of the stuff done. So we feel very optimistic that the president, with these people, I mean, if you look at who he's surrounding them with, they're the leaders in tech and AI in the world. And it's nice that it's here at home, and it's nice that we're paying attention to it, and it's nice that we want to be the leaders in it. And because someone's going to lead, and someone's going to take advantage of it, why shouldn't it be us? And so if we focus on it, like I think this administration is doing, I think it's a great opportunity to bring jobs to the United States, bring them back to the United States, and to create a better and stronger economy by doing that as well. So I think it's a very, very strong thing. And you're looking at different portfolios around the world, even the institutions and the sovereigns that are looking at, they're all looking at how much more are they going to increase their allocations to these products.
You know, we talk a lot about tech, and clearly this is an area that the president wants to make sure American leadership is sustained. What other sector would you focus on as something that he is really pinpointing and can make a difference here and move the needle in terms of bringing American exceptionalism back?
Well, tech is huge, but oil is probably the biggest, right? So the effect of energy in the world is so important. And you see that, and you can't get away from that, because the waterfall effect of oil prices goes all the way to the grocery store when you buy a carton of eggs, because of transportation and everything else. So it's very, very important that we maintain energy efficiency and that we can turn on the spigot, like the president say. And so I think that's going to be a huge part of the administration and a huge part of the acceleration of the economy as well.
All right. John Koudounis, CEO of Calamos, thank you so much for joining us today.
Thank you. Appreciate it.
While we were talking, of course, and throughout this hour, we've been getting earnings, and some of them are pre-announcements, some of them are formal earnings. Let's take a look at some of the big movers here. Texas Instruments, the latest chip maker to announce on the heels, of course, of results from SK Hynix. Texas Instruments giving a forecast that signals the chip slump continues to persist. That stock lower by 2.6% right now after the semiconductor index, the Philadelphia Semiconductor Index, fell about 0.5%. Intuitive Surgical losing about 1.5% right now. This is after it sees growth margin anywhere from 67 to 68%, whereas the consensus was above that level. And CSX, the railroad company, missing estimates when it comes to fourth quarter EPS, and that stock also lower by 2%.
Preliminary results also out of a couple of companies. Twilio, that's your big after-hours mover, up 9%. Boeing, one of the more notable decliners. That company also providing preliminary results as well here. And it looks like a miss on several key metrics, including operating margin, revenue, and deliveries. A full breakdown of what we learned out of Boeing when we come back after the break. Stick with us. This is Bloomberg. All right, let's take a look at shares of Boeing sliding here in after hours trade. The company was scheduled to report earnings on January 28th. Preliminary results out right now. The company recording a $1.1 billion charge tied to a work stoppage that it had. It also reporting that sales in the quarter are going to come in at about $15.2 billion. The street was expecting around $16.8 billion and a loss per share of about 5.46. George Ferguson joins us right now over at Bloomberg Intelligence. And I know Kelly Ortberg has only been on the job now for, 5 or 6 months here. But are you surprised here by the miss that we're going to see based on these preliminary results?
Well, first, I think that we all expected 4Q to be an ugly quarter anyways. And really what this smacks of is Boeing took a lot of charges on all their programs. This feels like another kitchen sink quarter where they just level the playing field and get ready to try to recover in 2025. So a lot of charges against all the programs really push them to a big loss.
George, how many more of these kitchen sink quarters do you think we'll be getting from Boeing?
Well, the most important thing I saw here was a cash burn, and I'm just remembering, I think it was roughly $3.5 billion. That's what matters the most, right? Because in this business, when you decide you've got like a loss-making program, you take losses you expect in the future and you bring them back to present day. And that's why they look so big when you take them. But that $3.5 billion cash burn, to me, Boeing's got plenty of cash on the balance sheet to manage that. We can't be doing that throughout 2025. But the cash burn, right now doesn't put them at risk of needing to raise more capital or I think lose their credit rating, and that's probably the most important thing.
In their statement here, they talk about some of those challenges, George, but more importantly, they talk about the steps that they're trying to take to stabilize the business. Now, they don't go into a lot of detail. Do you think we're going to get that detail when they report earnings and have that conference call next week?
Probably. It may be part of what the strategy is here, is to get the charges out of the way today, have everybody focus on that for a couple days, and then the call, perhaps they can have a sort of more positive stance as they talk about what they're going to do in 2025. I still don't expect a lot of guidance out of them, but I'd expect them to be starting to make positive noises about what's going to happen during the year. Yeah, it allows them a clean pivot, let's turn the page and move on to the future. George, appreciate your joining us today. George Ferguson of Bloomberg Intelligence with the instant analysis on Bowie's pre-announcement. Now, let's go back to the tech sector because much of the industry there is embracing the White House and its promise to ease up on regulation. And so far, it is paying off for those that invest in AI, with President Trump signing executive orders focused on creating a strong AI infrastructure in the U.S. Our next guest says the U.S. needs to move quickly to create an American form of AI regulation that supersedes the states or will get the worst of all worlds. Joining us now for more is Matt Calkins, CEO of cloud computing and software company Appian. Matt, it's good to see you. My question is, if the goal here is to move quickly on creating federal guidelines, rules of the road when it comes to AI, are executive actions really the only option at this point? Because actual legislation that involves Congress will be pretty difficult given the composition of Congress and would have to wait until after, the big, beautiful bill that's been promised on the budget.
Look, I think we can do some common sense things through Congress, and I believe it should be handled through Congress. There's some basics about AI that we should lay the groundwork on. Otherwise, we're going to have states like Texas using legislation like TRIGA to adopt a European AI Act style framework differently state by state across the U.S. And the reason that's the worst of all worlds is because it would be a patchwork of differing regulation, a higher burden for our companies trying to comply. And we wouldn't have had any American input into that because they're all riffing on the EU's legislation.
Does the European AI policy have anything good worth preserving?
It actually does. It's pretty good, and we wouldn't do badly to create a variation on it ourselves, but I don't think we should allow states to each take their own separate interpretation on it. I do like the way the AI Act focuses on the user of AI, puts the responsibility on the user to use it wisely, rather than the manufacturer to be sure that it cannot be used poorly.
Two questions on that, though. Does that maybe limit the adoption of it? If the onus is on me, am I going to be as eager to use it?
Yeah, specifically, it would be on you if you were a corporation using AI to make decisions, and then you're big enough and sophisticated enough to be sure that you're using AI in a responsible way. It doesn't mean it's the burden on an individual who's logging in to help write an email.
I understand that. I was speaking in kind of from the perspective of a large company, and we talk about this idea of not having, or at least not having right now, sort of a broad federal framework. It doesn't appear, at least if you believe some of the early comments out of the Trump administration, that they even want that.
They seem to want to be as deregulated as possible, and I understand that in terms of accelerating business, but there's some things that urgently need to be addressed. For example, AI is taking intellectual property and private information that belongs to American citizens and using it to make a product that turns a profit. Well, for those of us who own intellectual property or private data, we should be concerned about that. And I think an absolute start to any AI regulation would be to ask that the AI manufacturers disclose the training data that they're using, so we can all get more intelligent about exactly who's contributing to this and whether we should be getting some kind of compensation.
I'm intrigued by this idea that you say they seem more interested in deregulating more than anything else. Personnel is policy, and there are a lot of prominent tech leaders advising and working with the Trump administration. David Sachs, the new White House AI crypto czar. You've got Elon Musk, the first buddy. You've got Sam Altman, now part of Stargate, and Matt Grimes of Morgan Stanley, reportedly in talks about a possible role in the White House. Who do you look to provide that leadership, Matt?
Yeah, first of all, let me say it's good news that we've got these smart, AI-centric, tech-minded people involved in the government. It does mean that we have to watch them because they've all got a dog in the fight. They've all got a second angle, and it's important that we have a citizen's view on AI policy, not just a business leader's view. I think we need to hear all the voices, but it is actually a great thing that we have knowledgeable people, because until we understand AI at a federal level, we can't regulate it correctly.
All right. So what gets us there, Matt? I'm just curious as to who has the president's ear in the industry right now that could kind of facilitate that.
Yeah, well, I think there's a lot of people jockeying for his ear right now, and you saw that at the inauguration, right? There were many people behind him as he took the oath who would like to have a word on AI. But I hope that the new administration is going to listen more broadly, specifically to the interests of the citizenry, the people who own intellectual property or have private information. I think that they need to be heard as well, though I welcome the fact that he's listening to very knowledgeable, connected business people.
All right, Matt, appreciate you stopping by. Matt Calkins, the CEO over at Appian, a closer look at artificial intelligence and the regulatory guardrails that may or may not exist under the Trump administration. I do want to go back, Scarlett, to some news on Disney. We were talking about Bob Iger's pay, but now a new release specifically involving the company's experiences business here. Now, the chairman there, Josh D'Amaro, actually announcing a bunch of new appointments, including a newly created role to oversee major events integration. And this is interesting. They're basically naming people to kind of refocus this company around experiences themselves.
Well, maybe downgrading the media business, for instance, and elevating the experiences business, which, that brand is so valuable, right? The Disney brand and the resorts business, and how they integrate their various business throughout it, and how it reflects the brand equity across the resorts.
Ken Potrak is going to be elevated now to the newly created role of president of Disney Experiences, what they're calling major events. And they also point out here that they actually see some opportunity here and a prelude to the Olympics that are going to be in Los Angeles in 2028, as well as the 250th anniversary of the nation. Thomas Moslem is now the newly appointed president of Disneyland Resorts. A few other appointments as well. But again, this really just seems like a prioritization of a business that maybe they see as the future.
And you also wonder if there are any names in there that might one day be considered as CEO.
Well, that's the other thing. I don't want to speculate too much, but yeah, I mean, you see those names pop up, you see the elevation. Your first thought is, okay, which one of these people is going to succeed Bob Iger?
Are they in the horse race at all in any way?
All right, we'll keep an eye on that here. Of course, Disney making some moves, and a lot of moves in the market today. It could even be busier tomorrow. We're going to set you up for what to watch over the next 24 hours. This is Bloomberg. Wow, it's been a really busy day, Scarlett. I'm not sure what to say, but tomorrow could be even busier. A lot of things that could move the market, and we start actually overseas in Japan, a big rate decision.
Yeah, the Bank of Japan expected to raise its interest rates by a quarter point. This will be the second hike in this cycle, and we've seen dollar-yen kind of fluctuate in advance of this widely anticipated move.
Yeah, all the talk about American exceptionalism, but from an economic standpoint, Japan probably one of the more intriguing stories out there. We do come back to the U.S., where we do get quite a few earnings in the morning before the bell.
Yeah, American Express will be interesting, especially since it's made such inroads with millennials and Gen Z.
Yeah, and I was just taking a look at the stock. I mean, it's been rallying to the earnings, closing at a record high today. And I was looking at some of the growth numbers. 9% revenue growth is the expectation on the street on average. We're also going to hear from Verizon, NextEra Energy, and HCA Healthcare. Yeah,
so a good variety of companies across different sectors. Of course, it's all part of the lead up to the big tech earnings next week.
Yeah, absolutely. That's going to be a big one. Also, we're going to get some economic data tomorrow, including those S&P global PMIs, both manufacturing and services.
Yeah, and of course, we know the services economy is doing well. The manufacturing still suffering, still in recession, but hopefully improving. And that sets us up for sentiment, which has really taken a turn given the new administration and the election.
The final update on those sentiment numbers, and of course, our Davos coverage does continue here. Stick around. We are going to have Christine Lagarde as well as Larry Fink tomorrow. Definitely want to tune in for that, and tune in for us right here on The Close tomorrow, where we'll have all of your market moving action. Stick around. Balance of Power is up next.